Today's show will incorporate possible victories and challenges for Donald Trump and our reaction to them. And we end the show with how to create an intentional legacy for you and your family.
The McAlvany Weekly Commentary, covering monetary, economic, and geopolitical news events.
We do see monetary policy as being ineffective, and you see it in Japan, you see it in Europe. Look at the radical extremes they've gone to. They followed in our footsteps. And it didn't help us. It didn't help Japan. It hasn't helped Europe as of yet. Maybe it will. Maybe the argument will be made it just needs to be doubled down, tripled down, quadrupled down on, and then it will actually work.
Now here are Kevin Orrick and David McAlvany.
Welcome to the McAlvany Weekly Commentary. I'm Kevin Orrick along with David McAlvany. The contrast, Dave, between the Obama administration and the Trump administration is really something else. I know that Obama, immediately when he got in, he took a tour, international tour, almost apologizing for American exceptionalism.
Well, it is different this time because you're right. 8 years ago, Barack Hussein Obama launched what was unprecedented at the time for any president in the United States to go on a global apology tour. And, Bill King reminded us of that this week. And Trump is, quite frankly, far more apoplectic than apologetic.
Yeah, apoplectic against apologizing for America, basically, because apoplexy is anger at something. And Trump, he may not come across angry on TV, but I'll tell you what, Trump is angrily pursuing the things that he would like to make right, at least in his mind, from what was wrong.
No one is surprised by what he's doing because he said that he would do these things.
Right.
But everyone is surprised by the speed at which he's doing them.
Oh, it's going very quick. And actually, if you would look at reality, you would hope in some ways that reality would be catching up. But there are long time delays. In fact, I sometimes feel sympathy for what Trump is actually inheriting. I mean, the U.S. GDP growth, he's inheriting a recessionary economy at this point.
There were a number of very significant things out last Thursday and Friday that I think are playing into the markets this week. And U.S. GDP growth was certainly one of them, even with extraordinary election year spending, where we finished the full year at a positive 1.6% for GDP. That's hardly a number to be proud of. 1.6% is the lowest full year growth figure since 2011. If you were seeing us kind of come out of the doldrums, you would hope for a little bit more momentum than that. We had the fourth quarter GDP, which came in at 1.9%, which was surprisingly low given the estimates of growth from across Wall Street. We started very weak last year in the first quarter, and the equity markets sold off very hard. We had the markets down 10, 15, almost 20% here in the United States, and 30 to 50% declines in the emerging markets. And all of that was sort of covered over with this idea that it's going to be a strong finish to the year. They sold off. The equity markets were definitely reassured that third and fourth quarter growth would impressively rebound. And that's not really what we got.
Well, let me ask, we're talking about a lot of fiscal largesse with Trump and, with him spending and doing some of the things that he said. Will that increase the economic activity in the short run?
I think you have a revival in economic activity, certainly, if his fiscal policies are put in play and there is an increase in deficit spending. So 2017, you're likely to see a very positive turn in the economy. But the stock market is where the real hang-ups still lie. The stock market, I think, will vary and will be set with some challenges in 2017 in that particular category.
Well, I saw on the front of Barron's magazine, they were talking now that we've pressed past 20,000, by 2025, year 2025, go ahead and look for 30,000 on the Dow. I thought that was sort of a safe statement since we're still 7 or 8 years away from that. But, they mentioned something about corporate earnings, and I think it's important to get some clarity there because Barron's was talking about how earnings may just support a higher stock market. I think we need to look at where the earnings have come from.
And it's also important to recognize that a positive earnings season is a bit biased, and I'll get to that in a minute. But as we've looked through earnings for the fourth quarter, there's actually very few improvements in terms of revenue growth. That's the big thing, is you've had a number of firms which show revenue growth, but you look at the companies that they acquired this year.
Right.
And most of the revenue growth came from acquisitions, not from a growth in business. So the other issue, earnings beating expectations, that's become all too normal. And for the cynic in me, all you have to really do is lower your bar and make every goal more achievable thereby. I mean, it's not a real success story if you assume that, going from 10 cents a quarter to 1 cent a quarter, as long as you properly estimate and meet the estimates, that somehow things are all well.
Well, and you're not the only one seeing this. I mean, your key man over at McAlvany Wealth Management, Dave Burgess, he's looking through these earnings and he's saying the same thing. He's saying, look, don't be fooled. These are acquisitions.
Well, and when we own some quality Fortune 500 companies, and it's interesting, there's only a few that are actually growing. Most are flat or negative in terms of revenues. And where you see the growth, again, a lot of that's been from acquisitions.
Okay, let's go to the stock market for a second, because for 6 or 7 years, everything that the Federal Reserve, it was Bernanke at the time, and then later it was Janet Yellen, every little word that came out of these Fed presidents' mouths would make the stock market go up or down. Now, in a way, they're becoming irrelevant. It seems that everything that Trump does now, they try to explain with a stock market move. I mean, this immigration thing, they were blaming the stock market drop the other day on Trump's immigration policy.
Right. Well, it's been interesting 2 weeks in a row. If you look at the softness in the marketplace, in the stock market on Mondays, they have these great grand explanations in terms of the cause of the decline in
because
stocks.
Of what Trump said on the weekend.
Well, that's right.
Yeah.
So Friday set in motion this week's decline in stocks. The news media would have you believe that it was the inconveniencing of somewhere between 100 and 1,000 travelers following the 90-day immigration policy shift, and that is what's disrupting markets, and it's making investors uneasy. I say hogwash.
Right.
What you have on display is an extension of election media bias into the present, and really they're bringing no clarity to the picture. Here are the concerning issues which are driving market prices. You still have European interest rates, which are beginning to rise, and the spread between the highest quality, which would be your German, and your lower quality, French, Italian, Spanish, Portuguese, Greek, those spreads, the difference between them, is widening again.
Well, and Greece just shot up dramatically, didn't it? I mean, in one day, didn't we see how many basis point rise? 120, was it?
What it's indicating is there's further stress in the EU.
Yeah.
And in Greece, they're not quite saved. We thought they were saved. They've been saved, a dozen times now. Italy and France, they are the political hot potatoes. We've got elections coming up, and April is going to be funny season over in Europe for that reason. Those are the things that are bringing real uncertainty into the global financial landscape, because you've got key votes pending, and these interest rate shifts are occurring even as the European Central Bank is artificially setting prices using their $80 billion a month to buy bonds. In other words, they're trying to control prices, and yet their control is slipping.
80 billion euros a month. That adds up to close to €1 trillion a year. That's as strong as our quantitative easing program was a few years ago when we were in the depths of the financial crisis.
Add to that the across-the-pond critique of Trump's immigration policies, and that is serving to further divide and deepen the views held by many Europeans who, on the whole, have been witness to a massive decline in birth rates. At the same time, immigration policies have been liberalized. And Germany is an illustration of that. Reuters records that population in Germany reached a record this last year of 82.8 million.
But is it Germans or are they immigrants that are creating that increase in population?
Deaths have exceeded births in Germany every year since 1972, according to Reuters, and yet we see growth in their total population. There's 5 million fewer births in that time frame, and yet total growth. All the growth has come from immigration.
Right.
Here's the bottom line. Political surprise is like the soup of the day. Political surprise. We had it in Britain. We had it here in the United States. And when politicians don't pay attention to basic things like, demographics and their voter base and the changes in the demographic, you know what? This is what happens. And I think, my friend in Switzerland, Frank Seuss, used to say, the soup is cooked hotter than it's served. I think in this instance, it's the opposite way around. This one is being served just as hot as it's cooked. Dave,
people are starting to taste a little bit this possibility of throwing off the elite. Now, they may not even see what that is, but Germany has put up with this immigration, and a lot of these Germans are probably looking at this and saying, you know what happened in America what happened in Britain, I don't know that I want to see Angela Merkel in this next time around. I mean, we could see, like what Napier was saying 2 weeks ago, all it takes is 1 or 2 or 3 countries to not play in this 19-country European Union. And you could have a crumbling of that union this year, next year. I mean, with all these elections coming.
It's a very frail situation. And I think, we're concerned about issues driving the market and market prices. And outside of Europe, we mentioned a moment ago, U.S. GDP. It did not support the notion that U.S. domestic economic activity is finding stride. It is not finding stride. Quite the opposite. It returns us to the first quarter of 2016, wondering if current prices in the equity markets and the stock market are in fact justifiable. And we would argue, no, that they're not.
Well, and look at housing, Dave. We've got disappointing numbers still coming in, and a person could say, well, Trump has nothing to do with that. And that's true. But the problem is it is the economy that he has inherited. And housing, it was much more disappointing than what was expected.
Right. Less than 1% decline in home sales was what was expected for December. And instead, it was greater than 10%. That's what emerged. So the Fed, we have the FOMC communique, which is out this Wednesday, and that may in fact represent sort of the tipping point, if you will, for a reversal in positive equity market momentum. So the housing market is softer than expected. GDP for the fourth quarter, softer than expected. Full year, thus, is softer than expected.
Right.
But that's okay. We'll be fine as long as we can spend money. And again, I think the mainstream media loves the idea that Trump's policies are provoking uncertainty. Last week, Monday, you had an early decline in prices in the stock market, and that was met with outcries from the mainstream media of Trump representing destabilization.
Mm-hmm.
And then as the market streaked momentarily past 20,000, those cries were silenced. This week, Monday, the same. His immigration executive orders are tearing the country apart, according to the media. I have to be honest, I really enjoyed tweeting over the weekend. I do that on occasion, by the way.
Right.
But I enjoyed tweeting a Clinton video where he's talking tough on immigration. And, as he gets done with his speech on how he's going to triple, I think, or I don't know if it's triple or quintuple the border guards and send foreigners home, and he gets a standing ovation from Congress.
This was what, in 96, 97, when Bill Clinton was in office?
It was when he looked younger than he does today. So it was a little while ago. And of course, Obama shut out Iraqi refugees for 6 months back in 2011. So we're not talking about unprecedented actions on the part of Trump. We are talking about unprecedented press coverage and critique of his policies.
So for the person who wants to follow you on Twitter, you can follow at David McAlvany. And they can start getting those few and far between Twitters. How often do you Twitter, Dave?
I don't know. Sometimes it's 2 or 3 times a day.
Yeah.
Sometimes it's once a week.
Okay.
It kind of just depends if I have something in my craw or not. So, I'm putting up a few ideas here and there relating to family and legacy, because we are in the midst of launching the book, The Intentional Legacy, and that's now available on Amazon. But I'll mention that in a moment. I think what I'm particularly keen on here in terms of the mainstream media is particularly the business news networks, trying to shift blame and ignoring primary economic drivers. I think is unconscionable for a business news network. I understand MSNBC having a deeply flawed philosophy and needing to report on news in a way that is entirely representative of a perspective and a worldview. But when it comes to reporting on economics and numbers, you'd think that is something that's less apt to be monkeyed with in terms of an interpretation. And yet the mainstream media in the business context is also saying, oh, look, the stock market's going crazy because of Donald Trump. Actually, there's some really good economic numbers that were coming out. And over the weekend, this was absolutely amazing. Over the weekend, it was rumored that the tax cuts, which Trump has been proposing, would have to wait until the spring of 2018.
Right.
And as that hit the newswire, I was watching Dow futures sell off.
And it was a rumor.
But it's in anticipation of the market open following day.
Right.
These are the realities behind the volatility. Mainstream media is using sort of their paint-by-numbers approach to reporting. And to be honest, it's why alternative media is growing. Traditional media is dying, and they have no idea how out of step they are.
Well, and the media can move the market just on moment-to-moment basis, and central banks can do the same thing. But we do have this Trump mania going on, and we've had this stock market. It punctured 20,000. It didn't stay there long, and then it came back down below 20,000. How long can this animal spirits rise in the market last before reality starts hitting?
We may have found our limits. If it's not central bank easy money policies driving prices to the moon, it may be the animal spirits from the new treasury. Unless it's not. And that's the real key thing here. We noted this in December. There is a gap between the market prices reflecting the positive effects from fiscal policy shifts, and there's a gap between that and the time frame for when those measures can actually be implemented, which is 5 to 7 months from now. So we're priced for perfection today, and yet we have to wait for perfection until tomorrow. What happens in the interim?
Right.
It's relevant if someone's concerned about volatility or downside in the stock market.
Anyone who listened to the Bill King interview last week, this is a man who analyzes and makes stock picks all the time. And he basically said, no, I'm going to stick with cash and gold for now because it's very vulnerable.
How do you levitate the markets when central bank policy is in retreat and delivering on your promises is necessarily delayed due to the nature of passing initiatives through a legislative process? This leaves the stock market incredibly vulnerable over the next several months. And it's interesting. It's interesting to see central bank policy lose the limelight as the market driver, and Trump take center stage. At least the mainstream media is putting the spotlight on him.
Just like at a magic show, Dave, there's illusions going on, there's entertainment going on, there's things behind the scene going on. It does seem to me like right now it's a show. It's either the mainstream media or it's the central bankers making comments or it's Trump. And right now Trump is trumping the other two completely.
Oh, well, it seems like a show. It looks like a show. It's as entertaining as a show. And I think Trump is loving it. I think the new management team has everyone around the globe wondering what will happen next. And Trump loves not only the suspense and the drama of it, but the advantage gained in the process of negotiation, having everyone sort of on their left foot.
Yeah.
What's next? I don't know. We'll have to wait and see. And it's not a fun suspense if you're a foreign power. You don't know how or what to do next, or position ahead of time, which again, from Trump's perspective, gives him a huge advantage when it comes to negotiating deals.
Well, why don't we look at the tax cuts? Let's go ahead and contrast the old paradigm versus a new paradigm. Give us an idea of what that means.
Well, the new paradigm is let's simplify the code. And I think that's what we'll see, if it's now or if we have to wait until the spring of 2018. But the old paradigm is still in effect in places like Illinois. Fascinating. We do anticipate tax cuts at some point, and again, that's at the federal level. But in places like Illinois, they are, at this moment, considering a new tax called the business opportunity tax.
Don't you love the word opportunity right next to tax?
Opportunity for the privilege of working in the state. It's a new state level payroll tax up to 4.99% of individuals, income will go into that. Wow. And then companies just shy of 10% is the max rate. So you're talking about as much as a 15% increase in taxes through payrolls to the state of Illinois for the privilege of walking the earth, breathing the air, et cetera, et cetera. And I'm wondering if they've noticed the number of businesses leaving Illinois in recent years. They must think in some sort of, well, I don't even know how to describe the rationale.
Sort of California way.
In some sort of California way, only without the weather, that they expect hundreds of businesses to move to Illinois, knowing what a privilege is to work in the wonderful state of Illinois.
Well, speaking of paradigms, we've lived with a paradigm, Dave, all of our lives, you and I, with the United Nations just being another power in the world, an overruling power. But not everybody has felt that way. Your dad included, Howard Phillips included. Some of the men that you grew up with, Dave, really were worried about the United Nations. Now, they were patriotic men for America, but they were certainly not patriotic for this organization that Trump is possibly going to at least, maybe not completely defund, but back way off of.
Jim Grant, in his recent comments, made the distinction, I think we made the same distinction last year sometime in our commentary, between globalism and globalization,
right,
where globalization is the increase in free trade, open borders for the advantage of capital flow and the movement of goods and services. Globalism is more of an agenda, which is sort of a top-down management structure applied to who you are, what you do, how you do
with
it.
With favoritism et cetera. And little gifts that go on between pay to play.
I've always said, well, I'm all for globalization. That is the free market, in effect, taking advantage of where pockets of resources, whether that's human resources or actual physical resources, can be mobilized.
But you've never been a fan of globalism.
No, I haven't. So you've got CNBC that reports the Trump administration is preparing to dramatically reduce our role in the UN and other international organizations. And, just an anecdote here. My father, who is incredibly patriotic, served in the Air Force as a medic. Mm-hmm. When I was growing up and I was expressing an interest in serving in the military, his response was to discourage that career choice for one primary reason: the likelihood of wearing a blue helmet and being assigned to some post, some part of the world where the U.S. had no interest being a peacekeeper for an international agenda that may or may not reflect justice or a legitimate concern for an American citizen. And it was about the UN. That was the issue, not the U.S. military.
Right.
The UN was anathema to him, and certainly I grew up with that idea. So I look at an announcement that Trump may limit or reduce our role in the UN and international organizations, and I smile.
Right.
There's a sense of satisfaction, not because I'm a troglodyte that wants to go back to, an entire closed-off world. I'm all for globalization, but globalism is a very different theme.
Well, and that takes me back to Reagan. Now, this may cause the feathers to ruffle on some of our listeners who are just 100% for Reagan. But Reagan, Bill King just pointed this out last week. He pointed out a truth that your dad always knew as well. Ronald Reagan had many good things to do for the country, but he was a globalist. There were many things that he did that increased this globalization. This is where Trump and Reagan are different. This is one of the many areas I think we should contrast economically, politically. Trump is not Ronald Reagan.
No, and we discussed a lot of that in our Q&A programs in December. There's a significant difference between the backdrop of the Reagan administration and the current Trump administration now settling in at the White House. Reagan inherited the worst inflation rates since the Civil War.
Right.
He inherited short-term interest rates above 20%.
Double digit, yeah.
He inherited stocks at very low prices and low valuations, having been in a bear market arguably since 1968, with some really bad flourishes in the 70s, and finally bottoming between 80 and 82. Trump, on the other hand, inherits a zero inflation world with rates in real terms at or below zero, stocks priced rather rich. That's what he's inheriting.
Right.
Reagan had only improvement ahead of him, coming in as he did at the bottom of a bond bear market, and at the end of a stock bear market, and at the end of an inflationary era.
Right. It was bound to turn.
Trump, for all the promises to spend us into the promised land, has inherited not $1 trillion in debt, but $20 trillion. And of course, he's got the unfunded liabilities in Medicare, Medicaid, and Social Security, which are expected to reach the skies over the next 4 years, driven by something that is completely out of his control. Unless he implements something like Soylent Green, we've got a demographic issue. You've got more people who are going to be taxing the system than have ever taxed the system before, taking out their benefits, Social Security, Medicare, Medicaid.
Well, and one of the things that we try to do, Dave, when I watch the press right now, I see confusion. And when I'm talking to even money managers, there's a confusion. And what I'd like to hear from you is sort of a simplification of what we've been saying for the person who's listening and saying, look, I listened to you guys because I would like something a little bit more distilled, please.
Can I qualify that earlier statement? I'm not actually an advocate for Soylent Green. Just a comment in passing. But yeah, I would conclude simply that economic activity is going to be up during the Trump administration, that government largesse is going to be down, which is of huge benefit to Americans. Right. It's a little bit like cutting off the tail. It's not like cutting off the head of Leviathan, which I would fully sponsor, but it's like cutting off the tail of Leviathan. And perhaps Trump ends up being better than Reagan in this respect, and we'll have to see. But we might actually have a small government orientation inside the White House for the first time in generations. So from a socio-political perspective, or really a philosophical perspective, that's off the charts positive.
Right.
That's off the charts positive. But the financial markets are a different story altogether. The financial markets are going to move towards equilibrium regardless of his policies, which, while finding a few good things to take note of, leaves me with real concerns as to the direction of the financial markets. The vulnerability is less in the economy and more in the financial markets, which is in stark contrast to the Obama administration, where the economy couldn't get off the ground, but the financial markets sure could, on the sugar high coming from easy money and cheap credit delivered from the Fed.
So, Dave, this question is going to really need to be accompanied by the dark music of the villain in a melodrama. I think of the central bankers. I've never liked them. I don't think, like them. Everyone who was in power in this establishment is amazingly threatened by the Trump administration. Now, they're still in power of the things that they were in power of before. What are the chances that the establishment, the central banking community, the people who do not like Trump can just pull the rug out from under him?
I'm still enjoying in my mind Philip Glass and Dracula. So let me get back to that question. No, is it the case that ineffective monetary policies are being retired? I mean, this is, in my mind, a very big question you're raising.
Yeah.
Is it the case that ineffective monetary policies are being retired, or that central bankers are aware of their enemies at the gates? And who is their enemy? I mean, you're talking about really populism and a non-unified, what some have called the liberal agenda. Liberal democracy.
It reminds me of, we played a little clip the other day from Monty Python and the Holy Grail when these people were saying, "You're not my king." They said, "I don't know you. You're not my king."
Right.
And the central bankers, people are starting to say this about the central banking community. Wait a second. You're not my king.
Right. So do you feel an identity crisis brewing with the central bankers where they need to reinforce their relevance?
Right.
By creating a context of financial pain via tightening of the monetary purse strings? I mean, they have a choice now.
Yeah.
They have a choice, which is to look at weak economic figures and remain accommodative, or begin to tighten. And there's some indications, depending on where you look, that the economy is strengthening. But what are the consequences of raising rates at this juncture?
Right.
Can you maintain the Dow at just shy of 20,000 if you raise rates 3 times this year? I would argue that if they do follow through and raise rates 3 times this year, you can probably take 1,000 points off for every interest rate increase that they introduce. So could we be back at 17,000 in very short order? Absolutely. Absolutely. And that's the uncertainty that their policies bring into play. Now, in the midst of that, do they, on the one hand, sort of discredit Trump? Will they attempt to do that? Maybe. And do they try to reinforce their legitimacy by saying, okay, well, we're going to then accommodate, raise or lower rates, and again, sort of re-legitimize their place in the public square? This is a very interesting period of time.
Right.
We do see monetary policy as being ineffective, and you see it in Japan, you see it in Europe. Look at the radical extremes they've gone to. They followed in our footsteps, and it didn't help us. It didn't help Japan. It hasn't helped Europe as of yet. Maybe it will. Maybe the argument will be made. It just needs to be doubled down, tripled down, quadrupled down on, and then it will actually work.
Dave, often you talk about hedging yourself, and I think, obviously the safest way to hedge yourself is, for the unsophisticated way of going about it, the simplest way is gold. Gold goes up when things get uncertain. Cash, if the dollar stays strong. But I know for the person who's got a larger portfolio, hedging means something a little bit different. They can be gold and cash, but if they see, let's say we have a client who sees the stock market coming off 2,000 or 3,000.
Yeah.
How does a person benefit from that other than just owning cash and gold?
Well, I mean, this is a totally self-interested comment, and we put together a product that was entirely self-interested. It filled a niche that we had to have filled because it's something that we needed in-house and see as a major niche in the marketplace, a tactical short fund.
Right.
Doug Noland has partnered with us and our wealth management team, and the tactical short is unlike any other short fund out there in that we don't have to be short at all. We can sit in treasuries and clip very small coupons, but still be in the equivalent of a cash position, or we can be 100% short.
Which makes you very different than most short funds. Short funds a lot of times are just short all the time.
And anyone who's ever bought an ETF and been short, you're short all the time.
Yeah.
And you're 100% short in that position all the time.
And if the market goes the wrong direction, you just lose money.
That's right. It's painful, right? So this is a better way to approach that kind of an actively managed, daily rebalanced portfolio on the short side. To me, you know what it feels like? It feels like doing warfare a different way. It's something very simple, but very radical and very effective in the 1700s. Our guys address the lobster backs in a very simple way. I'm going to hide behind a tree. If I have the opportunity, I'll take a shot, and then I'm going to go hide behind the tree again.
Right. So they go short when they feel there's really enough tension in the market to be short.
To capitalize on it, then back away.
Yeah.
And that may mean that there's 3, 5, 10 different trades in a year, but we're after that particular pressure point and capitalizing on that particular market release in terms of pressure and volatility.
Right. And it's not for everybody.
No,
I mean, for the person
not.
who's just wanting to keep their portfolio simple, it's not for them.
No, I'll tell you who we designed it for. We actually designed it for institutions.
Okay.
And individuals can certainly look at it, but it's designed for an institution. If you're a pension fund, if you're an insurance company, if you're a family office, and there's a requirement that you be long equities, according to some version of the prudent man rule, or just how your mandate is laid out, is there a way that you can lower volatility and increase liquidity in the context of a market downturn while maintaining a primarily long exposure in your equities? And the answer is yes. And that's what we're attempting to do, is lower your total volatility for someone who must have a traditional equity exposure, but also provide an increase in liquidity in the context of a market downturn, giving you the ability to take proceeds, take profits out of the short fund and liquefy, move to assets that are thus undervalued at that point in time, and actually solidify an equity position, but giving you liquidity to do it. Tactical short. Our official launch is April, which is Q2, and I've already had dozens of people express interest in us doing that for them, the institutional and private level. So very excited about that. Yes, I agree. If you want out of the market, the easiest way is just to get out, sit in cash. But for some people, that's outside their mandate, and they can't. They can't get completely out. So yeah, we've long recommended a gold exposure as something to lower volatility in an equity portfolio.
And that's for everybody,
sure,
without exception.
And studies going back to the 70s and 80s have shown that a gold allocation within an equity portfolio increases returns and lowers total volatility. Mm-hmm. What this does is really actively engage on the short side. So we're in the business now, but we're kind of doing our formal open, if you will, in April. And we've been glad to not be short the last couple of months and not lose money. And here's the beauty. We don't have to, but we can. And that's the beauty of a tactical short, is when the opportunity presents itself, we take it. Otherwise, we're patient.
One of the things I've liked about you, Dave, all the years that I've known you, the last 30 years, is that you are forward thinking. You know, just talking about this short fund that you're thinking ahead. How could we possibly profit on a stock market that's falling without having to be there wishing that it would fall all the time? I like that. And you know what it reminds me of? You know, your book is coming out on legacy. Dave, you've always thought longer term than I have. Okay. A lot of times I'll look at the next month, 2 months, 3 months, and I'll say, okay, what am I going to do? You instead are making plans for the next 5 years, 10 years, 25 years. You told me about your anniversary trip this weekend with your wife. And I love the fact that through the years, you've had a wish list of champagnes, and they can be expensive, but you buy many years ahead of when you're actually going to enjoy them on future anniversaries.
You know, I think one of the favorite parts of the book that I just finished, The Intentional Legacy, is this idea of future memory, where we see and anticipate something in the future and try to bring it back into the present with certain actions.
A reverse engineering approach.
And when I look at 2017 and I see the amount of change which is occurring, the Trump administration, it's mind-boggling. There is a sense in which, boy, we don't know what tomorrow holds for us. And I would actually challenge that, because I feel that. I don't know what tomorrow holds from a business standpoint. I don't know what legislation changes. I don't know what changes in terms of an import tax at the border or immigration. You know, is my brother, who's in the process of becoming Indonesian, is he going to be able to come back into the United States? All of these things are very relevant to me.
Right.
But I say, in a world that seems out of control, is there anything that we can control? And I think that idea of reverse engineering, of saying, what are our highest ideals and expectations of what we want in our individual lives, but also as married men, as family men, for our family life, what do we want to see happen?
Well, and this is not a cold book that is just sort of isolated and objective. This is a very, very personal book. It took you a lot longer to finish this book than you thought, because you're telling your most intimate stories, Dave, of how you all learned as a family.
And it took me a lot longer to decide whether or not to even print it, because it is personal.
Right.
And so, I mean, if you're interested, you can pre-order it at Amazon. It'll ship February 7th. I will thank you for your purchase and a positive review. Please leave me. But the importance of the book is this. There's a lot of life that you're not in control of. What you are in control of is how you react to it, right, how you respond to it, and how you lead other people towards a particular endpoint. What is that endpoint? What do you want? What do you want? Have you really, as a couple, or even as an individual, have you thought, what's my goal here? Do I have financial goals?
Right.
Do I have intellectual goals? Do I have emotional goals? Do I have spiritual goals? Is it possible to actually lay out and say, this is the course that I'm on, and I want to manage my resources well? And the biggest definitional shift in this book is by saying that legacy is not just about tangible assets. It's about the intangibles too. And so while we may do well to look at a balance sheet with stocks and bonds and real estate and assets that we're all familiar with, some of us don't do as good a job managing the intangibles and making sure that as we manage those kinds of resources, that we are actually on track towards maturity and growth in those areas. I make the case in the book that if you neglect the intangibles, the tangible passage of wealth becomes much more difficult.
Well, Dave, just for the listener who's wondering what this is about, I'd like to just read the subtitles to each of the chapters. There's not many chapters. It's a 9-chapter book, but your introduction says it's an inescapable concept. We all face a legacy. It's either good or bad.
Well, and we do. We all leave a legacy. The question is it the kind of legacy that we want to leave? And have we been intentional about that? Or at the end of our life, will it be whatever it was, haphazardly? I hope it's okay, and I hope it didn't offend very many people.
Well, and I read the book. I got to read the pre-reader copy. I loved it. Chapter 1 was How Grace Can Save a Family Legacy. That's where your personal stories really come in.
What I mean by that is the ability for individuals to work things out. Do you realize how often in families you come across many crises, and those many crises create resentments, and those resentments lead to a breakage of relationship, and that breakage of relationship leads to a lack of identity? What do you have in the end where a family does not embrace the concept of grace and forgiveness? You have a family which is disjointed and it lacks love.
A good way to measure that is at the holidays to just see who came, who didn't come, who's talking to who, right? Well, your second chapter is about marriage, divorce, and staying on track. You put so much deliberate action into your marriage, Dave. I'm glad that you shared in this book, steps, things that you deliberately do to enhance that.
And one of the key points there is that redemption is a recurrent theme in relationship. A marriage that has worked has required redemption, has required forgiveness and healing all along the way. And by the way, a marriage that hasn't worked does still offer the opportunity of redemption. I mean, on the other side of divorce, my father was divorced.
Yeah.
My wife was divorced. I mean, these are common themes in our own family. I know them firsthand. Okay. And I know the pain of them.
Yeah, and Dave, that's another thing that I love about the book. Isn't every story in our life somewhat a redemptive story? I mean, we love, when we go to the movies, we love to see the story where Act 1 starts out, things are somewhat normal, and then a crisis occurs toward the end of Act 1. Act 2, this princess who gets captured at the end of Act 1. Act 2 is about coming back and taking that princess away from the dragon. You have some sort of redeeming force. And then, of course, Act 3, we see things restored back, not just to normal, but there's a better restoration. I mean, obviously, it's the theme of your faith, Dave. It's the theme of my faith. We have a redeemer, but built into the narrative of our hearts is redemption in every aspect of our lives.
And, honestly, I look at this and I see such a parallel to the financial world, because you look at liabilities and assets and you look at the things that propel a company towards growth or represent something which is debilitating to its future success. And you look at change which can occur. Sometimes it's catastrophic change. You have exogenous events that occur which can negatively impact a company, or endogenous events which can, from inside the company, destroy it or make it better. And all of this, again, deals with resource management, an appraisal of what you have, where you're going, and strategically thinking about what can be. What are the possibilities?
Well, not only possibilities, but what are the possible disturbances? You talk about the blessing, chapter 3, of disturbance. I mean, without the disturbance, we don't move ahead.
It's a fact of life. I mean, as much as legacy is a fact of life, disturbance is a fact of life. We can't avoid it. I mean, it can be as simple as the Starbucks in your neighborhood goes out of business. That's a disturbance to some. Or it could be a significant financial setback. It could be someone being diagnosed with cancer in your family. That was one of the disturbances that I talk about in the book, because Mary Catherine and I had to go through that the 4th year we were married. And how do you react? How do you respond? Again, how do you organize your resources, tangible and intangible, in the context of legacy? Because the stuff of life is what makes for legacy creation, for better or for worse.
Right. And you're not always responsible for all the legacy that comes into your family. Chapter 4, Legacy Baggage, which is an inquiry into the proper disposal of generational junk. Let's face it, I'm a dad. I had a dad. I had a grandfather. I've got a son. I know that my son has some of that generational baggage, as much as I try. And we need to identify that. and realize that that's part of this legacy journey.
And again, just like in a company accounting for liabilities and assets, the baggage that you receive from a past generation may represent that liability, that debt, that burden, but you also receive assets. And I think being grateful for both is an important component. The key point is to account for both and figure out what is helping you and what is hindering you. Because again, resource management. If you're creating a legacy and you are effectively stewarding the resources that you've been given, you have to account for everything, both the good and the bad.
Well, and to continue on the good, chapter 5 talks about the times of your life, creating a family identity. And you tell me about what you do with your 5-year-old daughter every morning. You're building a memory. It's so simple what you do, but it's beautiful because you're building a family identity and you're building a relationship with a 5-year-old girl who loves you and does not want to do it without you.
Every morning we wake up and have a spoonful of honey, and it's just the two of us. I wake her up and she usually asks if I'll carry her downstairs. So whether it's on my back or in my arms, I carry her downstairs and set her up on the countertop, and we have a spoonful of honey and talk about her dreams and talk about if she slept well. And it's 5 minutes while I'm making coffee for my wife. And for her, it's everything.
Well, but what did she tell you? Because you travel quite often, and she told you that she really wouldn't do it. She wouldn't have honey without you.
And I thought to myself, how do you create solidarity inside a family? What are the building blocks of loyalty within a family? I mean, these are big questions, and I don't know, except that I think we've made progress towards that in a spoonful of honey in a 5-minute conversation, just a little one-on-one time in the morning.
Well, a biblical concept that I love in Lamentations, which is not a book that most people read for encouragement, but you get to Lamentations 3 and it says, it is good for a man to both hope and quietly wait for the salvation of the Lord. And I think of your treasure hunts chapter in chapter 6. Treasure hunts in a family. Explain that just a little bit, because talk about putting hope in a family.
Well, I mean, we do treasure a very different way. I mean, one, we obviously like gold and silver, and everybody has a treasure box. And, actually, my 5-year-old daughter last night was insisting that I come into the room. And of course, I'm working on notes for the commentary, and she's, you have to come into the room. And I knew she had cleaned her room, so I already kind of knew what she was going to show me, but I didn't. She wanted to show me 13 ounces of silver, and she was so proud of her 13 ounces of silver.
Right.
And she's 5 years old, and every bit of allowance that she gets, she prefers that over buying dolls or other things, and this is what really is a part of her treasure. But we've done treasure differently as a family in the sense that we also look at the books that we surround ourselves with and the art that hangs on our walls, and we see ideas framed on our walls, and we see ideas in the covers of the books that are on our shelves and that inform our life. And we know that one of those ideas may in fact change our life. It may change our family. It may change our community. It may change the world. I don't know which book, which chapter will do that, but they're there latent in it.
Well, and you build relationship into that treasure. I've watched you do that as a family. You build the relationship into the treasure. It's not the silver that she's proud of. It's that Dad is proud of the silver that she's proud of. And you've shown them so many times the value of something like that. Or the books. You talk about John Adams' Stone Library, and you've tried to build that same, that front room when I come into the house where the kids are homeschooled, Dave. It's a magical front room. There's exactly what you're talking about. There's treasures all over the place.
There's a piece of the Berlin Wall that Mary Catherine chipped off in
on
the 80s.
The shelf.
Yeah. I mean, just little things that tell stories and bring people not only into a living history, but into ideas which, again, are not intended to be sort of tantalizing teasers for the intellectual, but things that give life to an individual and their family.
Well, and for practicality, because the people who are listening to the weekly commentary, these are all interesting things, but Dave, you are in the financial industry. It's your area of interest. And so, as we get into chapter 7, the financial legacy, you take great pains to give a person a long-term, multiple lifetime outline, basically, as to what is a financial legacy in a family and how to avoid the pitfalls. How many families have been destroyed with a great inheritance?
Well, and the reason why 6 comes before 7, not just numerically, but we talk about treasure hunts, is because it's important to figure out what's in your heart and how you manage what is inside, not only your heart as an individual, but in the hearts of the people in your family.
Yeah, Dave, it still goes back to relationship. It's not about the money.
Well, and that's what Chapter 7 really is addressing, is about the money. But before you get to addressing the money, you have to address issues of the heart.
Yeah.
Because the hard structures that you can create, employing a tax accountant, an attorney to create trusts and wills and things of that nature, that doesn't get to the more important substructures, the soft structures. Those are hard structures. The soft structures are the things that deal with family identity and what is in the heart and mind of an individual, your children, your grandchildren, etc. So 6 has to precede 7 because 7 doesn't really work without issues of the heart and the treasure which you've focused on.
Well, and then that takes us to Chapter 8, where you literally sit down and you chart for future generations, charting the future generational pattern.
To me, Chapter 7 and 8 are kind of where the rubber meets the road, where you start getting practical. Not only have you come up with an idea of what an intentional legacy is and can be and should be, but now how do you do this stuff?
Yeah.
So the practical financial piece is followed by the family dynamics and things that you can do practically every day. I mean, you don't think it's a big deal to spend dinner with your family? Well, I do, as a matter of fact, think it's a big deal to spend dinner with your family. What are the things that you talk about? What are the priorities in conversation? Are you dissecting public policy choices? Are you talking about economics and politics and finance and philosophy and faith? All of these things factor in. Where do you have time to factor those things into your life, into your family life? Actually, mealtime is one of the only times that it happens on a practical basis. So Chapter 8 gets real rubber meets the road-ish, if you will.
Well, and then you finalize things with Chapter 9. And I will tell you, Dave, there are things in my life that I look back and I go, ooh, I really missed an opportunity, big time. And you invited me a few years ago to a reconfirmation of yours and Mary Catherine's marriage. And I had other things going on. It was around the holidays, and I probably didn't take it as serious as I should have, because when I read that last chapter and when I talk to you, I realize the Bible talks about remembering. It's important to remember. That's what you do in Chapter 9. You say, look, we're not just going to do these things once. We're going to go back and we're going to remember. We're going to recommit. We're going to renew. And that's another form of redemption followed by reconciliation.
Albert Gray said that any resolution which is made today must be made again tomorrow. And we wanted to invite our kids into commitments that we had made long before they were around, so that they understood what it was that we were about, what the importance was, this thing we have, relationship, and actually include some degree of accountability by making a commitment not only to each other, but with them present, a commitment to them. This is us. This is who we are as a family, and this is where we're going. It was a trajectory setting moment. And I think if there's any way to summarize the book, it doesn't matter where you're at. It doesn't matter where you begin. You can always set a new trajectory. And it's important to do that over and over again, to appraise where you're at and where you're going and set the proper trajectory. That's what I wanted to include in the intentional legacy. What do you want for your family? Why do you want it? How do you get there? It ended up being much more of a personal exploration than I anticipated. And that's, again, why I had some hesitation in even publishing it, because it is, from 50 odd years of wealth management experience, the combined exposure that my dad and I have had to the different stories of what worked and what didn't work, success and failure, learning what we could from other people with gratitude in our hearts for that, but also learning from the mistakes and blessings within our own family context as well, dissecting it in a graceful way so that we can set a better trajectory. And that's, in fact, how I start the book. I ask and I hope that my kids write a better one.
Dave, I'm going to sound like a book salesman here, but I don't care. I read the book, but actually my mom read the book first, and it made her cry. It gave her great ideas. She wrote you a long letter that I never got to see, okay? But what I would recommend is every person listening to this who enjoys the commentary, enjoys what you bring to the commentary. This is a very personal expose, but it's also practical. And so go to Amazon. You can pre-order the book, and actually they will be shipping February 7th, is it?
That's correct.
Well, in life is about management of resources. And you talk every week about management of financial resources, economic resources. We talk about politics and geopolitics based on these resources. But that's not all there is.
Yeah, it doesn't matter if you're an individual or the head of a household, a mother, a father, a grandfather, a grandmother. A, it's never too late to begin setting that trajectory. And B, these are resources that matter. As much as I care about every week putting my heart, mind, and soul into understanding the way the economy is functioning on a global basis and what the inputs are, I want to know the inputs that go into this family dynamic that we have and my own personal growth and development. If I do not care for those resources, if I do not manage them well, if I don't care about the inputs, then you know what? You can have the equivalent of a 1929 crash on an emotional basis. We see it all the time. We all have stories of people in our lives who've had some sort of a crash. And it may have been unnecessary. It could have been handled better. This is the importance of the conversation, a broader conversation on legacy and the resources that you're creating as you manage and intentionally design your own legacy.
Thanks for listening to today's McAlvany Weekly Commentary. We'll see you next Wednesday. Be sure to follow us on Twitter at ICA Gold for our latest updates and market thoughts. And David, we talked about this before. You can follow David at David McAlvany. You can also go to davidmcalvany.com to learn more about this legacy concept that David put in the book. If you want to learn more about us, you can visit us online at McAlvany.com. Or if you have questions about precious metals, investing, recommendations, give us a call at 800-525-9556. For over 40 years, our experienced advisors have helped our clients preserve and diversify their portfolios. Thank you for listening to the McAlvany Weekly Commentary.
This has been the McAlvany Weekly Commentary. The views expressed should not be considered to be a solicitation or a recommendation for your investment portfolio. You should consult a professional financial advisor to assess your suitability for risk and investment. Join us again next week for a new edition of the McAlvany Weekly Commentary.